Welcome to iAIM Investment Management's first quarterly update for 2023. My name is Rose Marcello, and I'm a Director, Client Portfolio Manager at iAIM. Today, I will be speaking with Jean-René Adam about the heightened volatility within stock markets so far this year. Jean-René is Senior Vice President, Head of Public Equity. He leads both the fundamental and quantitative equity strategies. Good morning and welcome, JR.
Good morning, Rose.
Um, so far, we've had a difficult 2023, and after a very disappointing year for stocks in 2022, most investors were hoping that the worst was behind us. The year did start on better footing with battered growth stocks recovering meaningfully. Markets were pricing the end of the rate hike cycle, and economic indicators were even showing a positive reading. But the failure of two regional banks in the US, as well as a major institution such as Credit Suisse last week, threw a wrench into that. Markets have been very volatile. Jao, what do you think? And should we expect this to carry on for the rest of the year?
Yeah, it's a good point. Volatility have been very high in the first quarter of the year, but it's interesting to note that the major stock market indices are almost all up in the first quarter. But when you look into detail, there's so much going on under the hood. Performance disparity between the different sectors and industries is huge. For example, technology and communication are up almost 20% year to date, while energy and financial are down around 10%. It's kind of the reversal of last year with growth outperforming value now. To answer your question, I think that volatility is here to stay in 2023, given uncertainty in the economy. But I also think that the worst of the correction is behind us. It's clear to me that we are in a better situation than 2022. So remember that at the same period a year ago, inflation was at a very high level and on the rise, and central banks had still interest rates near zero. Not only did inflation was out of control, central bankers had to increase interest rates dramatically and aggressively. Fast forward today, a year later, inflation is still high, but it has been going down consistently over the last 8 months in both US and Canada. So the trend is very good. Now let's look at interest rate. Most central banks have indicated that they are pausing or about to pause to wait and see how the economy reacts, giving the lag effect of past interest rate increase. So interest rate might have peaked lately. So all that to say that we are in a better situation than last year. I think that the last shoe to drop, in my view, is a recession somewhere this year. The positive thing is that it is known and expected by almost everyone and will not come as a surprise. So, given this situation, I think that the share of the recession is already priced in the stock market.
Hmm. You speak of recession, and indeed, stress really started in the US in the banking sector, then it quickly spread to other sectors because it seemed to hasten the perspective of recession. And speaking of rotation, like the sectors that did well last year, were speaking of oil, energy, cyclicals, they were impacted the most. Um, which areas, if any, of the stock markets could bring the best performance for investors in 23, according to you?
Yeah, I think that the worst sector of last year, technology, will be the best this year, and two reasons why. The first reason is profitability. So remember that the last few years, these companies didn't really care about profitability as their stocks were performing very well. Financing was easy and cheap. Obviously, everything changed last year. And companies reacted aggressively the last few months and started to cut costs dramatically. We have all heard about tens of thousands of jobs being cut at Twitter, Meta, Amazon, and many more. They also decided to shut down many non-core projects where they were losing money. So even with a slowdown in growth, given the more difficult economy, these companies will be able to materially increase their cash flows. So this is the first point. Second point would be valuation. Excess valuation for technology companies is gone, given the correction that they have experienced last year. So when you look at the sector, it has a forward PE a little over 20 times, which is quite interesting given the secular growth trend of this sector.
Hmm. Looking at Canadian equity now, so the TSX outperformed the US stock market in 2022, primarily driven by energy. Canada was among your top picks last year, as well as for a more midterm perspective. So far in 2023, oil is lagging, and that has impacted both the Canadian dollar and the Canadian stock market. Are you still bullish Canada?
Yes, I'm still positive. Canada, I think it has lagged other regions this year, given the really the composition of the index, as you just described, right? It's tilted heavily in financial and energy, the two worst sectors year to date. So if we look at the Canadian banks, they just have reacted to the banking problems that we have experienced in the US. So it really went down in sympathy with the global banks. However, we all know that the banking sector in Canada is different and way more solid than anywhere else in the world. And it has been proven in the past over and over again. I think 2008 is a very good
Mhm.
example. So we think that it was unfairly punished, and as regulators in the US are acting to stop the contagion, they should be rate higher. As for the energy sector, it reacted to the higher probability of a recession this year, and historically, oil doesn't do well during recessions. So investors acted accordingly and sold the sector. While we don't disagree with oil demand being cyclical and going down during a recession, we believe that there are many positives that investors are overlooking this time. The first point would be oil inventories that are currently extremely low, which would soften the blow if demand disappoint. You have China reopening that will increase demand and could also compensate somewhat from lower demand elsewhere. OPEC that have been very disciplined at cutting production in the face of lower demand. And also looking at valuation at the current level, stock prices are really supported by very low multiple, and they're still generating very good cash flows also. And finally, the kind of the long-term bullish case for energy, all stocks to me is really the underinvestment in capex and new projects over the last decade, and this is still intact. Supply increase will be very limited in the coming years, and so when investors will start to price the end of the recession, the recovery, which could happen very soon, I think that oil price will react very quickly. So, these two sectors combined, so financial and energy, represent half of the S&P TSX, and I think they will help turn the tide in favor of Canada.
Yeah, so what I'm hearing is that the long-term trends that made you bullish in the first place are still relevant today, despite the volatility we're seeing in the short term.
Correct.
Yeah. Well, thank you so much, JR, for your time.
Thank you very much, Rose.